If you own property, you've probably been told your whole life, pay off your mortgage as fast as you can. But what if that's not actually the smartest move? My name's David, I'm a mortgage broker based here in Melbourne, and today we're unpacking one of the biggest misunderstandings in property finance, whether you should actually be paying your loan down or if there's a smarter way to use that money. By the end, you'll see why principal and interest is perfect for homeowners chasing security and why many investors deliberately don't actually pay their principal down at all. So number one, why paying down debt feels right. We've all grown up and been told that debt is bad. You work hard, you see that balance every month, and you just want it gone, and I get it. For owner-occupiers, that instinct, it's usually correct. You're not earning any rent, you're not claiming any deductions, and every dollar of interest you pay is after-tax money leaving your bank account. So when you pay down the principal, you're getting 3 wins. Certainty, your debt is absolutely shrinking. Security, your equity, that's growing. And peace of mind, you're less reliant on the bank day to day. That's why principal and interest loans make perfect sense when it's your home. They give stability and predictability, but when it comes to investing, the rules, they usually flip a little bit. If you buy an investment property, the goal isn't to own it outright fast. It's to build wealth while holding appreciating assets for as long as you possibly can. Here's the key difference. With investment loans, the interest is often tax deductible. Of course, confirm that with your accountant. So rather than pushing to wipe the loan out altogether, savvy investors keep it interest only and use their cash flow a little bit more strategically. Now that might mean paying down their home loan first because that is the bad debt which isn't deductible, or building a cash buffer or offset for safety, or saving for their next deposit to help grow this portfolio. It's not about avoiding repayments forever, it's about paying off the right loan first and not all the loans at once. So let's look at the mechanics between interest only and principal and interest. Let's take a $600,000 loan at 6% interest. The P&I repayment will be around $3,600 a month. Interest only, that's around $3,000 a month. That's a $600 difference every month, about $7,200 a year. With principal and interest, part of that repayment slowly eats into the balance, but interest only, you're just paying for the cost of borrowing. The debt doesn't actually change. For investors, that's often the point. When the focus is growth, the question isn't how fast can I kill the debt? It's actually how long can I hold this good debt attached to a good asset while keeping my cash flow safe? Now let's look at the cash flow advantage and have a look at a $600,000 example. Now, as you'll hear me say, the interest rates are slightly different between principal and interest-only repayments. That's often because the banks will load interest-only investment loans with a slightly higher interest rate. So this is how the example goes. Let's say principal and interest at 5.5%, you're paying $3,400 a month. Interest only at 6%, you're paying $3,000 a month. That, of course, is $400 a month difference, $4,800 a year staying in your pocket. Instead of giving that to the bank, you should park it in your offset account. Now, that $400 a month is continuously improving your cash position and cutting down your interest bill, a subtle form of compounding growth that will quietly help you accelerate your wealth. That flexibility is extremely powerful. Maybe you use it to add value to the property with renovations. Maybe it becomes a buffer for rate rises or vacancies, or maybe it's deposit money for the next purchase. And if you've drawn equity from an existing property, setting that split as interest only means you don't start paying for it until you actually spend it. So if you keep that money in offset, it's just going to be sitting there waiting idle and you're not paying interest on it while you're looking for your next property. And that's the key. Interest only isn't cheaper, it's just more flexible. You're not spending less, you're simply choosing where your money works its hardest. So if you're asking yourself which debt is best to pay first and of your owner-occupier and your investment, let's look at this side by side. Owner-occupier debt, or as we like to call it, bad debt. The interest generally isn't deductible, so paying it down is actually in your best interest because this debt is not working for you in any way whatsoever. When you pay down your home loan, it builds equity and it also builds peace of mind. It's more of an emotional pay down rather than a financial decision. When we look at investment debt, this is what we like to classify as good debt. The interest is usually deductible, and keeping it interest only frees your cash up to smash your home loan down faster and reinvest elsewhere. The aim of investment isn't actually zero debt. It's being productive with the debt so it can fuel your growth. And that's the difference between getting rid of debt and using debt. Both paths are going to actually build wealth, just at different speeds and comfort levels. Now, interest only sounds smart, but it doesn't always make sense because it's not actually for everyone. Like I've said before, if it's your own home, it's almost never the right move. That's bad debt, non-deductible, no income, so paying it down nearly is always the best way to use your cash. The real danger appears when the interest-only period ends. Most interest-only terms will last up to 5 years. There are some products that got 10 years now. Then they'll automatically roll to principal and interest. Subtly, you're paying off the same debt over 25 years instead of 30, which can actually spike your repayments by 30 to 40% just overnight. That shock can often catch people who haven't prepared for it. Experienced investors, though, they do plan ahead during these interest-only periods. Often, they're going to save the difference between what their principal and interest repayments would have been in their offset account, building some liquidity for themselves. They'll reapply for the same interest-only term if the strategy still makes sense, or smoothly absorb the high repayment because they've actually modeled for it a little bit earlier on. So without a plan, interest-only goes from helpful to harmful extremely quickly. So let's look at the bigger picture. A $600,000 property growing at 5% per year will add about $30,000 in the first year and roughly $165,000 worth of value in the first 5. Over the same period, you might have paid off $36,000 worth of principal. So early on, the growth actually well outpaces what you can pay down on that loan. Now let's layer in some inflation. At an average of 2.5%, that's $600,000 debt in 30 years' time, if you can manage to keep it interest only for that long, will actually have a value closer to $285,000. Your loan doesn't actually shrink on paper, but the purchasing power of the dollars that you owe will steadily go down over time. So inflation will actually lighten the load of this debt the longer that you can hold it. The property growth is going to increase your equity, income and rent will generally rise, which will improve your cash flow. And that's why most investors aren't obsessed with being debt-free. They respect debt, they manage it carefully, and let time, growth, and inflation do their work. But, and this is vital, leverage magnifies outcomes both ways. If the property underperforms or you overborrow, the same mechanism that builds wealth can amplify those mistakes. That's why structure, buffers, and discipline is more important than the interest rate itself. The modern lending landscape has changed quite a bit. Back in 2015, almost half of all new loans were interest only. That's until the regulators stepped in 2017, forcing a cap of 30% on the banks for interest-only loans. Today, interest-only only makes up around 20% of new lending, mostly for investors with strong incomes and buffers. And banks now test you as if you're already paying principal and interest, ensuring you can handle those repayments when the interest-only term rolls off. It's tighter, but it protects the borrowers and makes sure the strategy remains sustainable. So the real question, I guess, isn't should I pay my loans off? It's which loan should I pay off first? If it's your home, well, the answer is yes. Pay it down as quickly as humanly possible. If it's an investment, structure it properly, maintain your buffers, and let time, growth, and inflation do the heavy lifting, and only pay down that debt when it makes sense for your strategy. Smart investors get ahead not by being debt-free, but being debt-smart for the long haul. If you want to see how this applies to your situation, book a free strategy call. What we'll do is map out your loans, your goals, and your structure, and we'll make sure everything is done wisely.